Thank you for joining us on this beautiful sunny morning. For those of you who I've not met, my name is Ronit Holtzman. I'm the Senior Vice President, Philanthropy and Plan Giving and Endowments. And I wanted to welcome you and thank you for joining our second official advisors webinar, Making Tax Lemonade, with our speaker, Michael Goldberg. Before I pass the floor over to Michael, who has a very creative program planned for us this morning, I want to take a brief moment and highlight the great needs in our community and what the Foundation has been doing to address these needs. And as you can imagine, during these difficult times, our community needs are vast, unique, and growing. Our family of fund holders and volunteers at the Jewish Foundation and UJ Federation have donated time and money to assist with COVID-19 relief efforts at various organizations within our community. Through donor recommendations, tens of thousands of dollars have been granted from the Jewish Foundation directly to COVID-19 relief funds and relief efforts. In order to keep our foundation community, like you, engaged, we've co-hosted with UJ a number of webinars on a variety of topics, ranging from commercial real estate to estate planning. We've hosted a few of our own, more technical and tailored webinars, like this morning, for our professional advisors. For your information, we'll be hosting another professional advisor seminar on family law on June 3rd at 10 a.m. And please also mark down your calendars for our annual PAC seminar, which will be webinar June 16th at 8 a.m. I'd also like to take this opportunity to recognize our sponsors. Our presenting sponsor, Israel Bonds, our webinar sponsor, Seidel, and Graybook Realty Partners. We really appreciate the willingness of our sponsors to stick with us during these difficult times. This session is being recorded at 10 a.m. on May 20th. It will be emailed to everyone later today and will also be available on the Foundation website. Before I introduce Michael, a few housekeeping details. The chat function, which usually can be found at the bottom of your screen, will be available if you have any questions. Time permitting, Michael will try to address a few of those questions, so feel free to type away to us during the presentation. Luckily for me, I've had the privilege of working with very intelligent and thoughtful professional advisors like Michael, who has graciously offered his time today. Michael is a partner in the tax group at Minden Gross LLP. He works with clients and their advisors to assist them with their corporate, estate, personal, and international tax planning needs. Michael is also an active participant in the Jewish Foundation and has been a member of the Professional Advisory Committee for about 10 years. Please join me in welcoming Michael, and thank you again, Michael, for donating your time today.
Thank you, Ronit, and thank all of you for joining for this webinar. Really appreciate the introduction and the opportunity to talk to everybody about my topic, which is making tax lemonade, tax planning in recessionary times. Creating liquidity out of losses. And really, the goal today is to try and help you to understand certain planning opportunities that can be made out of these recessionary times. I will try and keep the discussion high level as best I can, but certain portions of the presentation do require a bit of technical finesse. And as Ronit mentioned, I'm happy to take questions at the end if we have time. And if not, I'm sure the UJ will send me the questions and I'll do my best to respond after the fact. My information is at the end of the webinar as well. So as I mentioned, the focus of today's webinar is to take tax lemons, which in this presentation will be primarily unrealized capital losses, and to figure out a way to unlock the losses to create liquidity in a tax-effective manner. And that would be the lemonade. I'll illustrate the planning that I'll be discussing using a client that may look familiar to many who have high net worth clients. And his name will be Mr. Wise and his family situation. Because of the nature of the presentation, the planning will be simplified. It's not really how I would set it up for a real client, but to try and illustrate the key components, I've simplified all of the facts and the actual strategies. You should keep in mind that whenever you're going to be working with a client and putting together planning opportunities of this nature, the recipe for the lemonade that you're going to be doing is going to be unique. And some clients will want a very straightforward recipe. Others will want to add some enhancements to the recipe, maybe a bit of natural or even more sophisticated sweeteners, and sometimes it'll be even stronger stuff they're putting in. The goal of the planners, the professionals working with the clients, is to figure out the right recipe for the particular client. Now, over the last 15 months or so, I've been immersed in family enterprise planning. And I'd be remiss if I didn't say that when doing tax planning, it's really important to try and get a sense of what it is that makes your client tick. What is their vision? What is the mission of the client? And to have that find its way into the planning, to ensure that the planning is consistent with the client's objectives, their long-term succession estate planning objectives, and quite frankly, you want to take into account their continuity issues as well. Because of time constraints today, I will not be actually setting out steps that one would do to put in place these plans. The idea is to give you an exposure to them, and hopefully you'll be able to help your clients to get that lemonade recipe right. So let's get on to Mr. Wise and his situation. I mentioned our client is named Mr. Wise. He's 64 years old, as you can see on this slide, married with 3 kids and 4 grandchildren. And let's just assume, for simplicity, that everybody's a Canadian citizen and resident. We're not introducing anything international, no US citizenship issues, etc. He's been an extremely successful entrepreneur over his lifetime. And back in 2010, he took steps to fix the value of his ownership in the corporate group, the Wise Group, by doing a traditional freeze. So he exchanged all of his common equity shares for a preferred fixed value shares, a frozen value of shares for those of you not familiar with the concept of a freeze, meaning that they can be redeemed for the value at that time. And the company that he held his shares in, which he also took back all the voting shares of, is a company I call TL Investments Ltd, which I'll just refer to as Holdco. You can think of what TL stands for, and I'll leave it at that. At the time of the transaction to do the freeze, a trust was set up for class of beneficiaries, including Mr. Wise's family and corporations and so on, called the Wise Family Trust. And the trust, which I'll refer to as the 2010 trust, owns all of the non-voting common shares of Holdco. I'm going to skip over the next number of slides and go straight to the picture on slide 7. You can look back at these slides afterwards, as basically they cover off everything that is in slide 7, but I find the picture is really useful in this type of scenario. And so let's look at Mr. Wise's group as at January 2020. You'll see that Mr. Wise, as I mentioned, owned all of the preferred and voting shares. You'll see I call them thin here. Some people call them thin voting shares or skinny shares. These are just nominal value shares that control Holdco. In addition, you'll see I'd mentioned the 2010 trust on the right of Holdco. It has 100 non-voting common shares, which at the time of the freeze were worthless. So in 10 years, this structure's done fabulously. Not every client's going to be at this level, but certainly you probably have a few that might be. And in this case, we're looking at $42 million of value. We go down underneath Holdco to the right, and you'll see that there is an OpCo. And the value of the OpCo shares is $30 million. Sole shareholder of 100 common shares is Holdco. And then there's a portfolio, and over here you can see the portfolio back at January 2020 had a value of $22 million, and its cost, ACB, was $20 million. You'll see that the only place I mention cost is with the portfolio. And the reason for that, and throughout this presentation, again, to keep things simple, I'm going to ignore cost. I'm also ignore paid up capital. Assume that they're just nominal unless I say otherwise in the presentation itself. So that note is down here. And also, you'll see that this is a structure, as I mentioned, that you probably wouldn't put in place for a person like Mr. Wise because it really doesn't do anything for capital gains multiplication for a structure such as OpCo, but we just want to keep this simple. So OpCo is held directly in this structure, wouldn't actually set it up this way. Now let's jump forward, and although this says May 2020, for those of you watching the markets and things, it's probably more March 2020 when I first started really focusing on these issues and thinking about this. I hope it's not July 2020, but the idea of this planning, and we're just going to assume that these values that I'm showing in here are sort of an accurate depiction, is to keep this stuff in mind, because this could become very, very important to gain, unfortunately, in the not too distant future. So you'll see that there's certain items that I've highlighted in red, and those are items that there's been changes to the facts. And in this case, the portfolio itself is literally in the red because the fair market value went from 22 million down to 15 million. We can think of a portfolio as a whole bunch of assets and there'll be gains and losses on it. For the moment, let's just think of it holistically as a single asset, and there's an unrealized capital loss of $5 million in the portfolio. And to that extent, assume that all of Holdco's shareholdings and assets that it owns are being held on capital account, not on income account, which means that any gains that are realized or losses that are realized will be capital gains or capital losses, not ordinary income losses and gains. You'll also see over here to the right of Holdco that OpCo shares have fallen in value to $20 million. That doesn't make those shares worthless in any way. They were 30 before, now they're 20, still a huge unrealized gain here. These facts, a lot of people are talking about refreezes. This isn't a refreeze situation. Mr. Wise's shares are still worth $10 million because the value of Holdco is well in excess of $10 million. But this has dropped the value of the 2010 trust from 42 million down to 25 million. And we'll come back to that later because that may offer some planning opportunities for a trust that is 10 years old, basically halfway through its 21-year cycle. Now let's step forward a little bit to Mr. Wise, who, for whatever reason, is facing a liquidity crunch. He's panicked and he's looking in Holdco at its portfolio and recognizing that that is a place that he could get some liquidity. Now, for the brokers in the audience today, I know that you're not going to, you're going to work very hard to avoid your client doing a full portfolio. But having said that, let's just assume, ignoring the practicality, that in fact the whole portfolio is going to get liquidated all at once, and there's going to be a sale. So because of that, we have a $5 million capital loss, as I mentioned. And just also to mention, let's assume for now that there have been no capital gains in the last 3 years in Holdco. So if we liquidate the portfolio, we have a $5 million capital loss, and there'd be no tax payable on that sale. So whatever cash comes from the sale, which would be $15 million, is tax-free in Holdco. As I mentioned, if there had been capital gains, which I suggested there weren't, in the same year, we could have had Holdco net those capital gains against the capital losses realized. Also, because there are no assumed capital gains in prior years, let's assume there's no carryback on the capital losses. So from a tax perspective, really all we've done is we've created a pool of unutilized capital losses that can be carried forward indefinitely in Holdco, but there's no immediate benefit to that tax pool. Change the facts just a little bit, assume there have been some capital gains that have been realized in the last 3 years. Well, it's certainly possible to carry back those losses and generate a tax refund. That tax refund isn't going to generate immediate liquidity for Holdco, but it will be possible to enjoy that, or it should be. One of the things to consider is if Holdco had paid dividends out to its beneficiaries, it might have received a Part 4 tax refund. If that had happened, then it's going to have to pay that back if we now generate a tax refund in Holdco itself. So you may not get as much of a refund as you think. The other thing is, not all taxpayers have situations that are plain vanilla. They may have done more aggressive planning transactions. And if you go and you ask the CRA for a refund, you're sort of inviting them in. So there should be some consideration as to whether it makes sense to get that refund, to go for it. What has this planning done? It's created corporate liquidity. There's been no ability to remove cash for Mr. Wise. If he were to try to take cash out of the structure for himself, he's going to pay tax. And this is really the key point that I'm getting to now on this presentation. And for many of you on the call, this is plain vanilla, simple stuff. It's not going to be anything new to you. But the reality is, many of you work with the brokers out there who are on the front lines, who will see the losses and the gains, who will have the clients coming to them to make these transactions happen. And they may not be aware of this. So this is what I want you to take away and go back to your clients, to, if you're the accountants that see some of this, to think about this and see how you can control this process. Is what happens if we had dealt with the CDA? The CDA is a tax-free account in the corporation that can be paid out to a person like Mr. Wise and get that liquidity and help him out personally. And unless planning is put in place in the proper order, it can be lost. The ability to get this tax-free cash from a holdco can be lost. Again, we've got a wide variety of people on the phone, or rather on the call. So I'm gonna just talk about CDA at a high level for those of you not that familiar, and then I'll have to get into a bit more technical detail as I go along. But in all cases, the discussion will be fairly high level and simplified, and always you should go back and have a person with skill in these areas look at the capital dividend account more technically. So capital dividend account is a notional corporate tax account that can allow a corporation to make non-taxable distributions of certain amounts that, if received by an individual, would have been taxed preferentially. For example, a capital gain is only taxed at 50%, and so a corporation should be able to get that 50% if it realizes a capital gain out tax-free. That's what the CDA account accomplishes. Insurance received by an individual, life insurance, is tax-free typically. And again, for a corporation, the idea of the CDA account is to create an ability to get the tax-free portion of the insurance out of the corporation to an individual tax-free. And the CDA account does this, and it's an extremely complicated account. And there are many different components. You can think of them as separate tanks in a tanker or separate pools. And I've listed a couple of the different pools on this slide. There are more. We have net capital gains, being the difference between capital gains and capital losses. That will be a pool that you can access from CDA. There's dividends that are received from other companies out of their CDA. That is a separate pool. Insurance proceeds are a separate pool. And each of these calculations are cumulative, and they're really complex. I'm going to focus in this presentation primarily on what I call the net capital gains pool, or the NCG pool. And again, this description of that pool is simplified, but basically on a cumulative basis since 1971, you're going to have or incorporation, whichever is later, you're going to keep track of the non-taxable portion of capital gains. Currently that's 50%, and you're going to be able to add an amount to your NCG pool. And for every capital loss, you're going to keep track of that as well, and the non-taxable portion, again 50%, is a reduction from the NCG pool. Depending on the timing, this pool can go negative. For example, if you had a new company and it realized, say, $1 million loss, it would have 50% of that, 500,000, go into the NCG pool as a negative, and now the pool will be negative, and it won't be possible to pay CDA out of the NCG pool for so long as that pool is negative. Here's some technical requirements to pay a CDA dividend. I'm not going to go over these at all today, but I just want you to have this for your benefit. And now I'm going to go on and provide some really straightforward, simple examples, and I'm going to build through the presentation in more complex issues as to what you need to do to preserve this CDA and make sure that the clients can get the best benefit that they can out of their CDA accounts. So really simple, straightforward NCG pool issue, a possible problem. You've got a corporation that today has a positive NCG pool, and that's because it had realized capital gains previously. And Mr. Wise goes to the broker, tells them to sell the corporation's assets. Capital losses are realized before the CDA is paid out. As a result, the NCG pool is going to be reduced, and the ability to pay CDA will either be restricted or lost. This could have been easily solved if someone had gone back and told Mr. Wise to speak to his professional advisors and have CDA made payable before triggering that loss. And that's what you needed to do. Didn't do it, could have lost hundreds of thousands or millions of dollars of tax-free cash. This is a little modification. In this case, we've got a portfolio. Now I'm going to break the portfolio apart and assume that there are some stocks in that portfolio in Holdco that actually are in a positive position and some stocks that are in a negative position. But if they're all liquidated at the same time, well, we wipe out the positive and the negative you're going to have no ability here because we know we've got a total loss of $5 million to pay CDA from the NCG pool. If the timing had been different, if the winners had been sold first, could have paid out CDA first to some degree anyway, before triggering all these losses. So, key takeaway, and for those of you, again, that aren't on the technical side, this is what I really hope you take away from this. Strategic use of CDA can allow your clients to enjoy tax-free liquidity from their corporate structure. This could make you literally heroes. If you're putting millions of dollars of money, or even hundreds of thousands of dollars of money into your clients' pockets on simple planning. Like, you don't need to have tax lawyers and fancy tax accountants to get heavily involved in this. You're gonna need someone to look at the CDA account and make sure that you're dealing with that properly. But beyond that and the proper preparation of some legal documents, this is not that complicated. There's not major reorganizations to the point that we're talking about right now. And all it takes is to keep these three simple things in mind. Realize the capital gains first, pay out your CDA next, and then realize the losses. And if that's all you take away, as I said, from today's presentation, hopefully it will make you super valuable to your clients. They won't realize how simple this is, and you will have achieved great things. One of the areas for brokers that I've mentioned on this issue is often in this type of situation, people are going to end up actually onboarding clients, and often when they onboard, the entire portfolio that comes in gets liquidated. People don't think through that if they'd taken the time to review this particular issue, not only could they have brought in this new client, they could have been a hero, creating all this tax-free cash for their clients. So that's a huge takeaway for some of you. For again, for the technical ones, perhaps just a bit basic, but let's keep on going. So CDA cautions. CDA calculations, I've mentioned, are super complicated. As a primary issue, for some clients, it may not be so easy to tell whether the gains are income or capital. While there are some elections that can be made to have all transactions to be deemed on capital account, I've listed the section there. There's pros and cons to those, and you should talk to your advisors about whether that's an election worth doing. Previous capital loss claims. Well, I mentioned that the NCG pool might be in a negative position, but I also mentioned that we've got these different pools in the CDA account. So you could theoretically have a new company that's had that $1 million of capital losses, so it's negative 500,000 in its CDA, and then it gets a big insurance payout, life insurance payout. Well, the life insurance is a separate pool, and if there's been no CDA paid out of this corporate structure, it's still possible, even with the negative CDA account on the NCG pool, to pay out the insurance from the insurance pool. So these things get complicated, and you need to have someone that understands them to help you through it. Another issue is that these, as I mentioned, are cumulative calculations. And the other cumulative calculation that gets kept track of is how many CDA dividends have been paid out over the history of the corporation. So that number, in order to pay a CDA dividend, the total aggregate of the various different pools has to exceed the total amount that's been paid out of CDA. So on the example that we just have been giving, that I was suggesting that you do for your clients, where you have your capital gain, pay out your CDA, and then trigger a loss. Let's just assume for a moment that we are in a negative $5 million position on the CDA. So that's 2.5. Capital gain was 5 million, so we have half of that goes to CDA. 2.5 million is our negative NCG pool, but we paid $2.5 million of CDA dividends out. Until we generate positive $2.5 million of new pool balances, we won't be able to pay out any further CDA. This can be an issue where the insurance is in a corporate structure like this now, and so there may be planning that needs to be done to try and deal with that. There may also be planning that could be done to try and manage this negative CDA pool situation. Tracking prior reorganizations, amalgamations and things, and making sure you understand how the CDA worked through, that can be tricky. There's also anti-avoidance rules that can restrict CDA claims. Then there's Part 3 tax. It's a special tax that applies if you pay a CDA dividend in excess of the CDA account. So even when you do a CDA dividend, the entirety of the dividend must be out of CDA. If you declare a CDA dividend for more than the CDA account, then you could be in this Part 3 tax, which is, as I say, punitive, You know, in some cases, if you've done this improperly and intentionally, it's difficult to get out of this particular tax. Other cases, the excess portion can be treated as a taxable dividend if the parties receiving the dividend agree to have that treatment occur. Best practices with CDA. And this one here is an interesting one. The first one, confirm your CDA balance with the CRA before you pay it out. Now, if you're rushing around, try and get CDA out before a loss, the reality is that's not going to happen. You don't have time for that. And so that best practice likely will fall by the wayside. And still make sure your dividends are, your resolutions are going to be carefully drafted to indicate the intentions. Been some case law that's been positive on that lately. Try and help you. The other thing is, you know, this isn't an all or nothing opportunity. If you were to be unsure exactly what the account was, but you're 100% positive that you know 80% is going to be there, getting 80% out is a lot better than nothing. And so you'll leave a little CDA on the table because you're working on a time basis that wasn't there, but that's better than nothing, which you would have had if you hadn't been thinking through this stuff in the first place. Let's put the facts of Mr. Wise's situation back onto this page here, and we're going to change things around a little bit. Again, look at the portfolio and assume now that there are, once again, there's no capital gains in that portfolio that we can trigger. There's no other assets that are easily triggered to realize gains in the Wise group. You know, how do we maximize our CDA situation? Well, one of the possibilities, of course, could be to sell OpCo or a portion of OpCo and create real liquidity. But let's assume that Mr. Wise has no intention of doing that. Well, there is a way to internally realize gains. You don't have to realize $20 million of gains on the OpCo shares, and I'm looking at OpCo now as being the key item here. We can choose to crystallize, say, $5 million of gains. And that's an internal transaction which requires corporate reorganizations. It's going to probably require some real technical expertise to do this properly. So this isn't something you should do on your own. This is something you should get an expert in to help. You can trigger that gain beforehand. So if you were to crystallize a $5 million gain, then pay out your CDA, then trigger your capital loss, that can get us to what we wanted to be with the more simple situation where we had other real gains that we could sell in the market and so on. This is an enhancement to the lemonade that we were talking about. It's a pretty natural enhancement if you ask me, but it's a very useful enhancement. And in this presentation, I'm going to call this additional enhancement a 4C strategy: capital gain crystallization, CDA, and capital loss. The first step, as I just mentioned, would be to crystallize the capital gain. So Holdco crystallizes a $5 million capital gain on its OpCo shares. And let's assume that we had nothing ever happening in Holdco's CDA pool previously. So we've got a $5 million gain, 50% of that gets added to the NCG pool, that's $2.5 million. And now we got to figure out a way to get it out. And previously I'd mentioned that it's Mr. Wise that wants the money. So for simplicity purposes, let's assume that it's not possible to get the money out through the trust to Mr. Wise. The only place we might be able to get it out is using Mr. Wise's free shares. Our typical free shares would have a dividend rate that is up to 6%. Now, 6% of $10 million isn't going to get us $2.5 million to Mr. Wise. So we're going to have to look for a different way to get him that money. And this is going to work out to be a good news situation because instead of paying dividends, let's redeem $2.5 million of Mr. Wise's preferred shares. On a $2.5 million redemption, you'll recall I'd said that the shares have no cost or paid up capital. Well, because they've got no paid up capital, the entirety of the redemption amount is going to be a deemed dividend, and provided that Holdco elects to treat that as having come out of the CDA account, this can be tax-free to Mr. Wise. So we will have got Mr. Wise the $2.5 million tax-free. Had Mr. Wise not done it this direction, had we triggered the capital losses before, getting the money out at eligible dividend rates would have been $1.2 million. If we were looking at eligible dividend rates, it could have been even more than that. Now, the other thing that this has done is it's actually redeemed a portion of Mr. Wise's $10 million of shares. And from an estate planning perspective, reducing what Mr. Wise has means we are reducing the ultimate death tax that he'd be exposed to at the time of his death. So we've taken $2.5 million off the table. That's about $650,000 that we've reduced of Mr. Wise's death tax. And we've now added one good thing to another good thing by doing this planning. This is just good common sense planning, and all because we're doing this in the right order, all because we're thinking through this a little bit more. Will it take a little more time than simply a sale into the market? Yes, but at these numbers, it's certainly worth it. If you're doing smaller numbers, you probably aren't going to get into all of this. If you've got sort of within your portfolio to do that sale before and trigger at least some portion of CDA, that may well be still a fabulous result for the clients. You don't need to get this sophisticated. Last step in the process, generate those capital losses. And we have the capital losses netted against capital gains and little or no tax payable in Holdco. So again, let's put up our picture. And at this point in time, following the implementation of the 4C strategy, you'll see underneath Holdco on the right, we've got a much fancier looking share structure. I'm not going to get into the technicalities of that, as I mentioned, but I will point out that these new 5,000 special shares have not only $5 million of fair market value, they've also got $5 million of cost. No paid up capital, but cost, because we triggered a gain on those. You'll also see that the portfolio is down to $12.5 million, which doesn't need to be the case, and I'll come back to that a little bit later. But the portfolio is down to $12.5 million, and that's because Mr. Wise took $2.5 million for himself. Preferred shares are down to $7.5 million, and we've done some good things in terms of reducing death tax in the future. There are cautions that you need to keep in mind whenever doing any type of planning, and the 4C strategy comes with its own cautions. Now, I think most people will probably go, this isn't a corporate circle strip, and I think they probably be right, and I agree with them. But the CRA is of the view that all distributions from a company are supposed to be taxable effectively. And if you go back to 2017 and that failed legislation the government released, well, even this type of strategy would have been caught. So can we absolutely definitively say that we are outside of sort of CRA's world of what they think a surplus strip is? We know that they're still looking at putting in legislation to stop surplus stripping. It is not entirely clear that this is fully risk-free. The CRA has provided some very positive comments, which I'll come back to later, about corporate transactions of this nature as being generally okay. But still, clients need to be aware of what they're doing before they get into it. And another issue is when you do any type of crystallization transaction, you're increasing the value of shares like Holdco from nominal to $5 million, but nothing has happened to the underlying assets of Holdco. So in the future, if those assets get sold, there could be double tax because you didn't increase the cost base in those assets, you only increase the shares. This is great if you end up with a share sale at a future date. So we do have enhancements to our lemonade. We've got clients that need to look at what the risks and issues are when they get into these things. And that was sort of the point that I wanted to make on this slide. Previously, I mentioned this type of planning may put restrictions on our ability to pay CDA dividends in the future. And another thing to keep in mind is the stop-loss rules in the Income Tax Act. The corporate rules in this case we're dealing with, they look to try and ensure that you've had a real economic disposition that's occurred. And if these rules apply because, for example, there is a person still owning that is affiliated with the party that otherwise would have realized the loss, owning an interest that's identical to or the interest at the end of a 30-day period, and the rules are more technical than that, the loss could be denied, in which case Holdco will pay tax, and this structure will not have been effective. So make sure that you don't run afoul of the stop-loss rules. Now that we've covered off the risks, let's continue on with some additional planning, because there are many flavors that we can add to this particular situation. For example, with that $2.5 million, maybe Mr. Wise just wanted a security blanket. He doesn't need the money. Well, we can use that money now to secure, assets within the corporate group. And in this day and age, that may be a very valuable thing. So lending back on security could be a very useful thing to do. Previously, I mentioned that the 2010 trust is about halfway through its 21-year period that it can accumulate value without having to realize any gains. Well, at 21 years is a deemed disposition of most assets in a trust, and unless you do planning to avoid those rules. Well, this is an opportunity. The value of this was $42 million back in January. Now it's assumed to be 25. If we actually froze the 2010 trust equity, then in 10 years, we aren't dealing with $42 million. We're dealing with $25 million. And I'm assuming that the market was to bounce back, things were to improve again within the next 10 years. That would be important consideration if you were going to go and do this type of planning. But it could be even worth more than $42 million, in which case you've got a ton of pressure to deal with those assets. Setting the value and freezing the trust value today takes that pressure off, and you might even be able to reduce that value over the next 10 years. Also, if you put a new trust in place, well, this is an opportunity to modernize trust terms. 2010, things were different than they are in 2020. The planning, as I'd mentioned previously, doesn't take into account multiplication of the exemption, although I'm still not going to show you planning that will do that. This would be an opportunity to improve multiplying capital gains exemption using this strategy. I'll discuss this particularly in the context of UJA. This may be an interesting option to enhance tax efficiency of charitable giving, certainly for some clients. Not for everybody, and there's a whole bunch of different ways that this could work its way through, but it's something to consider. Income splitting, that $2.5 million, it could have been used to seed a prescribed rate loan structure, possibly a trust. So there's all sorts of great flavors you can add to the lemonade. Let's assume that Mr. Wise does some of this. He lends back the $2.5 million note, goes back into Holdco, and it doesn't need to go into Opco, so puts it back into the portfolio. Now our investment advisor who was involved in all this is neutral to this whole strategy. Same assets that were there before, get kind of a reset in the portfolio to look forward to, and made their clients a hero by creating all this liquidity that can be generated, but it can be pulled out whenever the client wants or needs it. Win-win all the way around. The trust, we fixed its value at $25 million, and we've got a new 2020 trust, which has nominal value common shares that hopefully over time will become valuable in the future. Once again, I've done nothing in terms of capital gains exemption multiplication with this structure. I mentioned enhancing your donations. If we assume we're looking at that crystallization 4C strategy, let's just modify it a little bit. Instead of crystallizing a $5 million gain, let's assume we only crystallize a $4 million gain. So that generates our $2 million of CDA. And Mr. Wise through Holdco actually is wanting to do something for the UJA to help build COVID relief of some sort. So gifts $1 million of the Opco preferred shares over to the foundation. That $1 million generates $1 million capital gain, which gets us further $500,000 of CDA and $1 million deduction against any income in Holdco, subject to the usual limitations on deductions and so on in a year. As a result of this step of the planning, we've had total capital gains of $5 million and total CDA of $2.5 million. We've also got that nice deduction that we can use potentially, but what if we can't use that deduction? What if there's no likelihood of using that deduction in the future? Well, one of the possibilities might be to actually crystallize another $2 million of capital gains on the Opco preferred shares. That would would offset the full $1 million donation deduction, create $1 million of CDA, and now we've got $3.5 million of CDA. So instead of using just $2.5 million of CDA, we can take $3.5 million of CDA and get that out to Mr. Wise tax-free, further reducing Mr. Wise's death tax. We've made a charitable donation that was desired, and we've enhanced all of the other planning. And then we realize our capital loss to eliminate the gain, the remaining $5 million of gains that were triggered on the first slide. And this is kind of what the strategy would look like on these facts. There are, as I mentioned, a whole bunch of different ways to do this. It's difficult to actually value this. And for, I think, each client, it's going to be different. Some are not going to want to use up their donation deduction to create this type of liquidity and so on. Others, this may be very attractive for. By the way, if you're dealing with public company donations, there's no tax, there's no capital gains tax on the public company donations. So you can even enhance this planning further if you want to go down that road. I'm now going to completely change directions, move from the corporation to the personal. In this case, we're talking about personal capital loss strategies, still using Mr. Wise's situation and structure, but now we're going to pretend that the portfolio has always been owned by Mr. Wise. It's not in Holdco. So it's Mr. Wise that's going to cause the portfolio to be liquidated. $5 million of capital losses are triggered. There's no tax on the sale, and all the usual stuff in terms of how losses can be used is illustrated on this slide. Big difference between the Holdco situation and Mr. Wise's situation. CDA is only a corporate concept. It's not relevant to an individual. So if the gain and loss are before or after one another, it doesn't matter as long as they're in the same year, because you want to net them and not have to pay any tax. That's the only timing issue that you've got there. But again, consider any risks of generating a refund if you've had prior year capital gains that you want to carry your loss back to. Mr. Wise might have other assets that he could go out and sell outside the portfolio. If that were the case, he'd be able to sell those assets and enjoy even more tax-free cash, basically, because he just used the losses to offset, and he can do whatever he wants to. But let's assume that's not the case. And instead, he decides he's going to use the losses to offset them against capital gains that he'll crystallize on his Holdco shares. And we can do that. We can do a crystallization transaction at the Holdco level, increase the cost of those shares, and there'd be no tax. Now, this planning creates no immediate cash access from Holdco. To do that, you've got to do further planning. And this would require a reorganization to use up that cost base and get a further $5 million out of Holdco without tax. That's twice the tax-free cash of the 4C strategy, which only got us $2.5 million using CDA. But in my view, and I think the CRA's view, I think you're looking at a much stronger lemonade recipe. This is a much more, it's got many more issues associated with it. And in particular, this, I think most advisors would agree, is clearly a personal surplus strip. Furthermore, the CRA has, at the 2015 round table that's noted in the document below, they've indicated that if you do personal capital losses and surplus strip planning together, that they think they can gar you. They will likely attack that. There's the McDonald case that's listed where they were successful. So if you're going down this road, I think you really need to look carefully at the issues and risks, explain them to the client. It doesn't mean you can't do them, but the clients need to know that what they're getting into may be something that definitely is far from a sipping type of iced tea. We have the lock-in of double tax corporately that we talked about. That's still going to be the case here, but now we've only increased the Holdco shares. If you sold at the OpCo level, you've got a lock-in there. Plus, or rather, the shares of OpCo, you haven't done anything to increase their cost base at this point in time. And again, nothing down below in OpCo either. Once again, stop-loss rules need to be considered, and they're a bit different at the individual level. I will talk about the individual stop-loss rules more later in the presentation. So going back to our picture, I've moved the portfolio away from Holdco, and it's now shown before any planning's put in place as having been owned by Mr. Wise. Because Holdco doesn't have this $15 million of assets, the Wise Family Trust is only worth $10 million and not $25 million at May 2020. So let's talk about some additional planning opportunities. Oops, hang on a second. I think I moved one page too far. Sorry. This is what the structure might look like if Mr. Wise was to have implemented the personal level plan, you'll see a big difference is we've got this NewCo that's been added to the structure. And NewCo is necessary because 84.1 is an anti-avoidance rule that you don't want to get caught into. And again, I'm not getting into any technical implementation methods, but you just need to know that there are some additional complexities of doing this type of planning. If you look at NewCo, it owns shares that have $5 million of cost and fair market value. That's these special shares. And that's as a result of the crystallization of gains. And at Mr. Wise's level, on this fact scenario, I've assumed that he's taking back a secured promissory note and he's got his remaining common shares. There are different ways to do this. And this one here might not be as advisable, for example, from a risk perspective, as simply having taken back common shares worth $10 million, which would have cost and fair market value of $5 million. So you need to look at all these different things, advise the clients carefully, and get really competent help to make sure that the clients understand the risks and benefits of the plan. Close out the presentation, I'm going to talk about some other planning opportunities. And we're mostly going to stay dealing with losses, but there are some things that are just so important that I wanted to mention in this presentation at a general high level. So I will talk about some of them as well. And there are others that can be looked at. There are, you know, as creative as you can be, there are many different ways of helping clients in this down environment. So this slide is all about shifting unrealized capital losses. The first point is, let's assume you've got a low tax spouse with unrealized capital losses, and you've got a high tax spouse who is going to realize a capital gain or has realized capital gains. Well, it's possible to shift the unrealized capital loss over to the high tax spouse so that she can go and realize that capital loss and offset her capital gains with it. This involves intentionally triggering the stop loss rules between spouses. So you actually want the rules to apply. You want the spouse to continue to own the asset on which the loss would have occurred at the end of the 30-day period. And you have to elect out of various rules in the Income Tax Act between spouses that would otherwise cause attribution to apply. If that were to occur, you could shift the losses. You could also shift the losses into an affiliated corporation using similar strategies. And again, not wanting to get too technical, I'm not going to explain too much about what affiliation is. Assume it's a corporation that's owned entirely or controlled by an individual or his or her spouse, or to the spouse of an individual, him or herself. For trusts, we have, capital losses are realized by a trust. When that happens, there's no way to allocate the capital loss out to a beneficiary. The trust, if it has gains, can use it, but otherwise they're just going to sit there. If you've got unrealized capital losses, it is possible, the same as you can use unrealized capital gains and distribute and allocate them out or move the assets out to a beneficiary and make a distribution so that the beneficiary will inherit the cost base on an unrealized capital gain. You can do the same with the capital loss. And then the beneficiary, once they have the asset, can sell it and realize the capital loss, him or herself. Shifting, from capital to ordinary losses. We've talked about capital losses throughout and capital gains because capital gains create CDA. Well, capital losses, non-capital losses are super powerful in themselves because they can be applied against any type of income, whereas capital losses can only offset capital gains. Many clients will suddenly decide that their losses aren't on capital account, that they should be on income account. And, there are some risks to taking that position, particularly where it hadn't been taken previously, and that should be kept in mind. On this slide, I'll mention, as I just mentioned, is a loss on capital or income account. I'll also mention inventory. We've heard that unfortunately potatoes and other things are sitting in fields, and so they're becoming worthless. Under ordinary principles of accounting and tax, losses can be claimed and the inventory written down. When you're dealing not with potatoes, but dealing with real estate, very often the value should eventually come back. And not only that, may even go up. When it comes back, you've got to write back and take into income any unrealized, any unrealized gains that you had already claimed losses on. So there are planning opportunities to avoid that write-up. With land, you have to manage land transfer tax, but with a little bit of creativity, this is something I think that may become very relevant. The markets are behaving one way, but if this goes on for too long, it sure looks like many types of real estate for our clients might move the wrong direction. And finding a way to help clients use a loss without having to later on have it come back in income could be extremely valuable. I'll lastly mention on this slide, ABLES, allowable business investment losses. Those are a very powerful type of capital loss that can be offset against any type of income. Like I mentioned with clients claiming non-capital losses where they haven't had a history of doing, assume that CRA is going to review ABLE claims. So not to say don't do them on either side. Make sure up front you've looked at it, you've thought about it, and you've got details in your files that will be available when you eventually have that CRA review. Another little loss piece, turning to Mr. Wise's situation at the personal level. We had all those personal losses and he's got his preferred shares. Well, if he wanted to, he could actually transition those preferred shares to his kids. 5 million of them anyway, he could have given away with no tax. This is an opportunity potentially to push the succession planning forward at a reduced cost. For many clients, it might even be at no cost in some situations when you add in things like capital gains exemptions and other things that can be used. At the beginning of the presentation, I did mention briefly refreeze planning. If this had been a new freeze and the value of the trust was basically nothing back in January 2020, and now the value of the structure was maybe 5 million, well, it might be possible to simply have Mr. Wise exchange his existing preferred shares for a class of preferred shares that are now worth 5 million instead of 10 million. The advantage of that, reduction in death tax. That's really great planning. It's not as good as reduction of death tax plus a whole bunch of tax-free money that you got with the 4C strategy or just ordinary planning with CDA that we discussed throughout this presentation, but it's still something that should definitely be kept in mind. Corporate insurance planning. With COVID and with all the things going on, clients should be making sure that their insurance is in place, that it's up to date. If they're doing the type of planning we're talking about, think about where that insurance is living and how that may be impacted by this type of planning. I understand there are some issues with writing large policies at this point in time, but that will get fixed, I have no doubt. And I understand that it's already being fixed at a certain level. Prescribed rate loan planning. The rate will fall to 1% on July 1. That's been announced. Clients, that have liquidity, Mr. Wise, if he'd taken the $2.5 million, he could have lent it to a prescribed rate structure or to a spouse or whatever, and got into some income splitting. That would be, fabulous little piece of planning. For clients with existing structures in place, the question as to whether to adjust those or wind them up if they were at a higher rate, like 2%, it's not as easy as it looks. Some people think you can just exchange the loan and that's the end of it. That's not how it works. There are significant rules in the Income Tax Act that can restrict adjusting these structures, and it can be a pain. For 1%, especially for smaller prescribed rate loans, probably not worth the aggravation. Asset holding structures for your clients. Do they meet their needs? We talked about securitizing, taking retained earnings, moving them up and moving them back, although you're going to have to talk to an insolvency person as well and make sure that you understand the risks and issues involved in that planning at any point in time. The reality is those things should be looked at today, particularly now while things at least are pretty good. And your clients maybe have a little more time than they used to. Updating key legal documents or even putting them in place in the first place, and non-legal documents, wills, powers of attorney, looking at their probate planning, shareholders agreement, family constitutions and owner charters for those in the family enterprise sphere. These are absolutely key critical documents, and this is a time to do this, particularly with everything going on with COVID. I've now hit the end of the formal part of the presentation. Hopefully you'll be able to take some of these lemons that we've been handed, create some lemonade with them for your clients. Ranit, or possibly it's Brett, I'm not sure who, I'm happy to take a few questions with any residual time that we may have.
Well, yes. Hi, thank you, Michael. That was fantastic. Learned a lot about Mr. Wise and some effective tax planning for sure. We're really appreciative of your time, so thank you. If anybody does have any questions for Michael or about the Jewish Foundation in general, certainly you can email Michael or you can email me, Brett Henry. I'll put my email address up in the chat function. It's bhenry@ujafed.org. Also, just wanted to take the opportunity to once again thank our sponsors. For this morning, we have Israel Bonds, who was our presenting sponsor, and Seidel and Graybrook, our webinar sponsors. So thank you to our sponsors for sure. And finally, wanted to just thank all of you for joining us this morning. We hope you found the presentation interesting and informative and can hopefully walk away with a new piece of knowledge for sure. We will be circulating the recording of the presentation, so if you missed a slide or missed something or want to pass it on to a colleague, we will be circulating the recording later today or first thing tomorrow morning. And on behalf of the Jewish Foundation, that's it for us, and have a great rest of your day.